Hello, and welcome back to another, or actually our first really, lecture dealing with Chapter 5. And Chapter 5 is all about CVP analysis. This is probably my favorite topic out of this course. CVP analysis is really fun, right? Because it allows us to do a lot of what if analysis, right? What if my sales go down? How does that affect my bottom line, right? What if I have some sort of change in my cost structure, meaning variable cost change or fixed cost change? What does that have to do with my bottom line? So as opposed to going through the PowerPoints and just boring you, really boring you to death with lecture videos, what I want to do instead is just go through some problems and talk about what's important and so to kind of reinforce those reading or reinforce the material that you read, as well as provide a number of examples on, okay, here's how we solve these problems. So we're going to start off with exercise 5-14, which is actually something you have to do for your study guide. So I'm on page 230 and I'm looking at exercise 5-14. So we have to calculate the break-even point and we have to do some target profit analysis. So they tell us that the Linden Company is the exclusive distributor for an automotive product that sells for $40 per unit. They tell us that Linden Company has a contribution margin ratio of 30%, and the company's fixed expenses are $180,000 per year. They also tell us that the company sells 16,000 units. Okay, so we got a lot of information there. But before we jump into the requirements, I kind of want to cover the contribution formatted income statement first. Right? And we know that the contribution format statement, or the contribution, would really help if I know how to spell, wouldn't it? The contribution format, remember we said it's bad, right? Because it segregates. It segregates based on the behavior of the cost, right? Is it variable? Is it fixed? So remember, I believe I said this in an earlier chapter when we covered cost based on behavior. Get used to that format or get comfortable with that format of segregating out variable and fixed expenses. So what does the contribution format look like? Well, remember, it's our selling price minus our variable costs. That equals our contribution margin. Okay? From there, we subtract out our fixed costs, and then hopefully we have once we subtract out our fixed costs, we have either a net operating income or maybe we have a net operating loss. Okay, so one of the questions in your study guide was asked about the contribution margin, right? What is it? Well, it's very important that we understand this concept of the contribution margin, okay? The contribution margin is what is left over after all the variable costs have been deducted from the sales price, and it's what's left over to cover fixed costs and hopefully provide for net operating income, okay? Very important we understand that concept of how do we get the contribution margin and what does it do, right? And again, this skeleton here of the contribution formatted income statement really tells us, and it's a visual of what the contribution margin is, right? Again, it's what's left over after variable costs have been subtracted from price, and it's what's left to hopefully cover our fixed costs and hopefully to provide for a net operating income. Okay, so we read the problem, right? And there was a lot there, right? We had a sales price of $40 per unit, CM ratio of 30%, and then they gave us our fixed costs. So let's just plug in what we have. So we know the sales price is $40 per unit. Ooh, wrong way. Okay, so we know it's $40 per unit. We don't know what the variable costs are. We don't even know what the contribution margin is. But we do know that the contribution margin ratio is, oh, sorry, this mouse is a little touchy. We know that that's 30%, okay? So what does that mean? What does that contribution margin ratio of 30% represent? Well, it is the percentage of sales that's left over after variable costs have been accounted for to cover our fixed costs, right? So another way to look at it, we could say that basically 30 cents of every dollar that we sell goes to covering our fixed costs and hopefully providing for net operating income, okay? We know our fixed costs are $180,000, okay? So I have enough information here to figure out what our contribution margin is, what our variable expenses are, and what our variable cost percentage is, okay? So how do we figure that out, right? Well, we're looking for what is the variable expense. That's what number one asks us. What is the variable expense per unit? Well, it's very simple for us to do because we know just by, bear with me here, just by the mathematics of it, right, that contribution margin is a percentage. Fixed or variable cost is going to be a percentage, right? Well, the sales price has to be 100%. We know that. We know it has to be 100%. We know that, right? Because we're taking money out of our sales to cover variable costs and to hopefully have enough left over to cover our fixed expenses. So we have enough here to figure out what the variable cost is, right? So how do we do that? Well, the first thing we're going to do to figure out our variable cost, we're going to take our price of $40, and we're going to multiply that by 100% minus 30%. Okay? So basically what we're doing is we're trying to figure out what our variable cost is, right? What the variable cost is per unit. But just by looking at it, we could tell just by looking at it that 70% of our selling price goes to cover the variable cost. Okay? What's left over? Well, that 30% of contribution margin. So, if we take basically our selling price times 70%, we end up with $28. That is our variable cost. Okay? Now, step two, or number two, requirement two says, hey, calculate the break-even point in units and in dollars. We can do that, right? Remember, there's two ways we could do that. We could use the equation form, or we could use what? The formula, right? We could do either or. Really doesn't matter which one we do. Okay. Um, so let's use the equation form. Okay. So what do we need to know? Well, the first thing that we need to know is how do we calculate the break-even point, right? Well, how we calculate the break-even point is our contribution margin, divided by our fixed costs. Okay, this is how we find in units, right? This is a unit problem, right? If we want to solve the problem in dollars, we have to divide by the contribution margin ratio. Divided by fixed costs, okay? So very important takeaway is that you understand if we're looking for dollars, we got to use the ratio. If we're looking for units, we got to use the unit CM, okay? So before we can even dive into this problem, first thing we need to figure out is what's the contribution margin, right? Well, it's easy. Contribution margin is selling price minus variable cost. So if I just plug that into Excel, I get $12. The contribution margin is $12, okay? So for number 2, we need to figure out what is the break-even point in units. Let's do dollars first. Let's do dollars. Okay. So, what's the easiest way I can do this? Well, we can either use the equation form or we could use the formula. We're going to use the formula. Okay, so we're going to look in dollars, right? So how do we figure that out? Well, very simple. We're going to take our contribution margin ratio of $30 and we're going to divide that by our fixed expenses, which are $180,000. Okay? Bear with me here. I just want to make a little bit more room. There we go. Okay. So what then is our contribution? What is our break even in dollars? Well, we take our 30% and divide it by our $180,000 of fixed costs. Oh, that's because I did it the wrong way. There we go. My bad. $600,000. $600,000 is our break even in sales dollars. Okay, and actually, I apologize. I messed up the equation. So let me fix that. Oh, good Lord. Let me fix that real quick. There we go. Okay. So it's, I apologize, fixed costs over unit CM to get the units, to get the dollars, it's fixed costs divided by the CM ratio. Okay. And again, that should be unit CM. Okay, now we're on the right track. I apologize. Okay, so that's a break even in dollars. Why did that not work? Oh. Pesky math, you know. There we go. Okie dokie. Okay, so now let's figure out what's the break even in units. How many units do I got to sell to break even? So what does that break even term really mean? Well, we want to know how many units or how much do we need to have in sales dollars to cover the variable costs, have enough contribution margin left to cover the fixed costs, and there's not going to be any profit. Okay, profit's going to be zero. So we covered all our costs, but we didn't make any profit. Okay, it's a good number to know, right? How much do I have to sell, or how many? What's my sales units in dollars and in units? How much do I need to sell in order to cover my costs? Right, that's pretty important. So again, to figure out the units, we're going to take our fixed costs, and this time we're going to divide it by the unit contribution margin, which is our $12. We're going to run the numbers. Oh, I apologize. My mouse is so touchy. By 12, 15,000 units. Okay, we have to sell 15,000 units in order to break even. Well, let's look at that. Okay, let's look at that in contribution format, or contribution formatted income statement. Is that right? Well, sure it is. Okay, so we know that the break-even point is 15,000 units. So I know my selling price is $40 per unit. So I'm going to say $40 times my 15,000 units. That gives me $600,000. Incidentally, that's the same calculation, the same number that I had for my break even in dollars, right? So now we got to figure out what's the total variable cost. Well, that's easy. I already figured out that my variable cost is $28 per unit times the number of units that I'm selling, 15,000 units. That gives me $420. So what's my what's my contribution margin in total? In total, it's just sales minus variable cost, 180,000. Look at this. What's my fixed cost? 180,000. So what then is my net income or my net loss? Well, I take my contribution margin minus my fixed costs, and I get zero. That's my break-even point, okay? Now, I want to show you something else that was in the reading, and I just kind of want to, just want to show you to illustrate a point. Now, keep in mind, we've already done two, right? The answers that you need for two that are in your for your study guide are these two things. This, what I did, is just for demonstration. I just wanted to prove that, hey, we are at the break-even point, okay? What if, let's just say, what if I sold 15,001 units? How much is my net operating income going to increase? Okay? What's my net operating income going to go up by? There was a concept in the book, and I hope you guys picked up on it, that once we hit the break-even point, our net operating income will increase in the amount of the unit contribution margin. I'll show you what I mean. So let's run through this again, right? So if I sell 15,001 unit, what's my sales price? Well, just run the numbers. Selling price of $40 times my 15,001 unit. Oh, I made $40 extra. That makes sense because $40 is the sales price. Okay, what's the variable cost? Well, in total, we take the $28 times the quantity, which in this case is 1501, equals $420,028. Okay. Well, what's my contribution margin? Well, again, it's the difference between sales and variable cost. Look, I got 12 extra bucks here, right? Or it's $12 higher than it was before. The fixed costs are still going to stay the same, 180,000. So what then is my contribution margin? What happened? It's $12, okay? What happens if I sell one more unit? So what happens if I sell 15,002 units? My contribution margin, or I'm sorry, my net income is going to go up by the amount of my contribution margin, which is $12. So we're going to have $24 of net income. So I take my price times my quantity, and this time it's 15,002. I calculate the total variable cost. Which is the variable cost per unit times the quantity. To figure out the contribution margin, I take my sales minus my variable cost. I subtract out my fixed cost. To figure out what my net operating income is, I take my contribution margin minus my fixed costs. So it went up by $12. So the point is, once we hit the break-even point, your net income will go up by the unit of the contribution margin, okay? Let me show you one more thing. I know that 15,000 units, I'm just going to plug that in right here so we know what it is. 15,000 units, I know that's my break-even point. What if I sell 16,000 units, okay? I want to know how much will my net operating income go up, okay? This is why the contribution margin is such an important concept. I don't need to take all that time, right, and multiply selling price times the quantity, then take the variable cost per unit times the quantity, subtract them. That's my contribution margin. Then I subtract out my fixed costs, and then I subtract my fixed costs from my contribution margin. There's the net income. There's such an easier way to do it, okay? Such an easier way to do it. I could tell you right now, our net income is going to increase by $1,200. Okay, it's going to be $1,200. There's an easier way to do this. Once you're past the break-even point, all you need to do is multiply your unit contribution margin by the change in the quantity. Okay, so just to make it easier, we're going to go with the 15,000. Okay, so we're at 15,000. Our net operating income is $0. How much is our net operating income going to be if we sell 16,000? I don't need to do the entire income statement. I say, well, this is easy for me to do. I know that my change in quantity is 1,000. Right? How do you know that? Well, 15,000 to 16,000, that's a difference of 1,000 units, right? I'm then going to multiply my unit contribution margin by my change in quantity. 12,000 bucks. Sorry, I was off $1. Dollar always screws me up, or the places always screw me up. So the point is, if we sell an extra 1,000 units, again from this 15,000, our net operating income is going to be $12,000. Okay, and again, I did that the quick and dirty way. What's the change in the quantity? above the break-even point, multiply it by the unit CM. That's why it's such a very, very important concept, okay? Now let's get back to the problem. I'm going to scroll down just a little bit for us. Okay, so let's get back to the problem. So number 3 says, excuse me, so sorry. Number 3 says, what amount of unit sales and dollar sales is required to attain a target profit of $60,000 per year? Now, the break-even equation, and I'm just going to copy these. The break-even equation is such an important equation to know, okay? Why? Because this tells us how much we need to sell to have zero profit, right? Or gives us the number of units, or I'm sorry, gives us either the number of units or number of dollars that we need to sell to have zero profit. What we can do is take this equation, add to that the target profit, and that tells us exactly the number of units or the number of dollars we need to sell to hit that target profit. So what we're trying to find out is, how much do I have to sell to cover all my costs and provide a profit of X dollars, okay? So, show you what I mean. So we can modify this equation, maybe. We can modify this equation by saying, taking the fixed cost and adding to that, I'm going to say TP, and that just stands for target profit, okay? Target profit. It's not toilet paper, it's target profit. All right, so what do we know? Well, we know right off the bat that our unit contribution margin is $12. We know that the unit CM ratio is 30%, okay? We know that, right? We know if we're looking for dollars, we got to use the CM ratio. If we're looking for units, we got to use the unit CM, okay? So, what are our fixed costs? Well, our fixed costs are $180,000. That didn't change in the problem. So I'm going to say $180,000 plus problem says what? $60,000. How many units do we need to sell? Well, that's easy. All I have to do, plug it into Excel, 180,000. Actually, do it this way. 180,000 plus 60,000 divided by our unit contribution margin of 12. We end up with 20,000 units. So in order to make a profit of $60,000, we have to sell 20,000 units. And again, this is in units, not in dollars. The reason why dollars came up is because of my equation. Okay, so we're going to do the same thing here. We want to figure it out in units, right? I'm still going to use the same fixed cost plus target profit, but this time I'm going to divide by my CM ratio. So I'm going to say equals, open parentheses, 180,000 plus 60,000, close parentheses, divide by 30%. That gives me $800,000. So what's that mean? That means if I want to have a profit of $60,000, I'm going to have to either sell in units, 20,000 units, or $80,000 or $800,000 in sales. Okay. If you take the 20,000 units that we have to sell, multiply them by the sales price of $40, we're going to get the 800,000. They're not two different numbers. We're just looking at the information two different ways, either in units or in dollars. Okay? So let's look at 4. Four says, that assume that by using a more efficient shipper, the company is able to reduce its variable expense by $4 per unit. What is the company's new break-even point in unit sales and in dollar sales? Then the next part says, what dollar sales is required to attain a target profit of $60,000? So right now, we need to recognize, and I'm going to look right here, we're changing our variable cost. That means we're going to have a new contribution margin. So for number 4, we need to calculate the new CM and new CM ratio. Okay? How do we know that that's what we have to calculate? Because our cost structure changed. Our variable cost went down. Okay? So, very easy to do. Okay? And I'm going to come here and I'm going to say, well, my selling price is still going to be $40. That's not going to change, right? Problem didn't say your price changed. They just said, hey, your variable cost changed. Okay? So the variable cost minus variable cost. The variable cost was $28. It decreased by $4. So that's $24. So I'm just going to say the calculation 28 minus 4 gives me $24. Okay, we're good. We're doing okay. So what's the new CM? What's the new contribution margin? Very simple. $40 minus 24 bucks gives us $16. So our new contribution margin is $16. It went up. It went up $4. Okay. What then is our percentages? Well, remember, sales is always 1% or 100% rather. Excuse me, I just want to change these. Okay, good. So if we want to figure out what is our variable expense, right? We're just trying to figure out what percentage variable cost is of the selling price. 60%. Okay, so I'm just dividing the variable cost by the selling price. I could do the same thing with the contribution margin, the 16 divided by the 40, but it's easier to just look at it and say, well, 100% minus 60% is going to give me 40%. So our contribution margin actually went up, okay? So you need to have this in your study guide. When we're, when we're done, I'll go back through and show you what, reiterate what you need to have in your study guide, okay? So now we got to calculate the new break-even point. Well, again, it's very easy for us to do. Very, very easy. We have to do it in units and in dollars, okay? So let's figure that out. Let's do units first, okay? So remember, we take our fixed costs and we divide that. We divide that by our, which one? Unit contribution margin or contribution margin ratio? Hopefully you said unit contribution margin because we're looking for units. So we're going to use our unit contribution margin. So we're going to take the 180,000 of fixed costs. That did not change. We're going to take our new contribution margin of $16. And we're going to divide these. And our new break-even point is 11,250 units. Okay? So now we need to figure out what is the break-even in sales price. Well, I could take my fixed costs and divide it by my contribution margin ratio, or all I have to do, bear with me here for a second, break even in dollars. All I have to do is take the break even in units and multiply it by the selling price. And it should be 450,000, which it is. Okay. So the point is, once you have the break even in units, there's two ways to get the break even in dollars. You can use the equation form or the formula form, or you can just take the break even in units and multiply by sales price. Same thing. Okay. So you should have this part in your study guide. Okay. And then the last part says, hey, can you please calculate your break even in sales dollars? That's it, right? So that's easy for us to do, right? Or I'm sorry, target profit in sales dollars. So to figure out the target profit in dollars, hopefully you remember the equation. What is the equation? And I'm hoping you said fixed costs plus TP, or target profit, divided by my CM ratio. Hopefully you said that. Okay. So we have a new contribution margin ratio here. It's 40%, right? Our fixed costs are still 180,000 plus that target profit of $60,000. That equals 240,000. So what is our, let me phrase that. How much sales dollars do we need to provide a target profit of $60,000? We divide, and we end up with $600,000. $600,000. Okay? Which incidentally is the break-even point under the old structure, right? See that? Because we did that previously. If we had 15,000 cells, units and cells, that ends up being $600,000. That's an old break-even point. But because in this example, the variable costs went down, our break-even in units went down, and let's go back here for a second. Previously, with a contribution margin of 30%, our cells that are needed to provide for a profit of $60,000 was $800,000, right? That went down to $600,000. Why? Again, because our cost structure changed, our variable costs went down, our contribution margin went up, our contribution margin ratio also went up, okay? So here's what you should have for your, to answer the question, right? You need this first part, and you need this part, okay? To figure out number 3, you just need what we did down here, and to figure out number 4, you just need what we did down here. Okay? So that is exercise 5-14. When we come back in our next video, you have another problem you have to do, and if I remember correctly, that's exercise 5-18, which is the break-even target profit analysis. We're going to look at a margin of safety, and we're going to look at the CM ratio. So we're going to see exactly how to set that problem up. So please tune back in for that video.